Hey everyone, welcome to another episode of Brett's Brain. Today I'm going to walk through 5 key elements that every founder needs to pay close attention to in a term sheet that you might get from an investor. Hey, I'm Brett Burrell, former entrepreneur, current venture capitalist. We do Brett's Brain to try and help entrepreneurs succeed, so make sure you share this out with other people that it might be able to help. Like, subscribe, do all those things, and ask us questions like how can we help you in your journey? Okay, term sheet. There's a lot of information in there. It's a legal document. It can be boring to read. But founders, you have to go through it and you have to understand what's in there. I'm going to walk through 5 of the key things that are in a term sheet today, but there could be more. There could be less. But as I've said in previous videos, when you get your term sheet, it's actually better for a founder to do all your negotiations up front before you sign. So you want to walk through all the key elements and make sure that you're at a general understanding with your investors prior to signing that term sheet. Because once you sign it, oftentimes term sheets have no shop clauses where you can't go out and raise additional capital. And so basically leverage is no longer in your corner once you sign that term sheet. So make sure that you've negotiated and you've come to agreement on all 5 of these key things and anything else that might be outstanding. But if you don't see these 5 in there, you need to make sure you have that conversation. So number 1, general round dynamics. Pretty simple, pretty straightforward. How much are you raising in this round? How much are you allowed to raise up to? One thing to look out for is oftentimes a founder is like, okay, you committed $1 million of my $3 million round. We're going to go ahead and close that $1 million first. That's usually not the case. Usually you have to either raise the entire round amount or there'd be a specified amount in the term sheet that says you can't close until you've raised at least $2.5 million. That's when your first close will occur. And that's really important if cash is tight for your planning, for your raise. So know that just because you get a term sheet and you get a commitment doesn't always mean you're going to be able to close right away. You might still have to continue to fundraise before you can hit that milestone for the first close. Okay, number 2, valuation. Make sure that you have a clear understanding of the valuation that's being given for your company. Now, if you're doing a SAFE or convertible, most term sheets are going to be priced rounds because you don't always need a term sheet for a SAFE or a convertible, but you can issue them. But on a priced round, it's what's your post-money valuation, what's your pre-money valuation. Understand what the valuation that's being given. Make sure it's correct with what you've talked about with your investors, because what's on the term sheet is what's going to go into the documents. So make sure you negotiate valuation prior to signing term sheet. Sounds obvious, but obviously it's one that's important to pay really close attention to. Number 3. Liquidation preferences. So this one's a little bit more obscure and it's just not something that people talk about all the time, but it can have a tremendous impact on what you actually make when you sell your company. And so liquidation preferences basically at a high level are when you sell a company or when there's a cash event, who gets what money when. So if you have a multi-billion-dollar exit, it's tends to be a little bit less important, although it still can be. But when you have those, middle exits where you sell a company for $40 million and you've raised $10 million, it makes a huge difference in who gets paid, how much, and when. And so if you have a 1x liquidation preference, basically it means that all the money that you've raised gets paid back first before any common stock, so entrepreneurs, your stock, gets paid anything. So if you've raised $10 million and you sell your company for $10 million, there's legal documents that say all your investors are getting all that money. So even though you sold a company for $10 million, you could get nothing as an entrepreneur. And that's what you're signing up for. For most seed stage, pre-seed stage, even Series A stage companies, anything more than like a 1x liquidation preference is out of market. So make sure you're pushing back on anything that's more than a 1x for early stage rounds. And 1x liquidation preference means they're going to get just their money back. A 2x or a 3x would mean they would get 2 times or 3 times their money back. Now, I could talk for minutes and hours probably just on liquidation preferences, but we're going to move on to the next topic, number 4, which is protective provisions. Okay, so this one's really important also. These are the things that are going to be who can vote on what, who can approve what. How do you vote on those things? And so when you invest in a company, an investor often asks for different things to protect themselves from all different kinds of stuff, like issuances of new equity, going out and raising more capital. There's all different kinds of terms, and you can kind of put anything in there and you can say, hey, this is how we're going to decide on whether or not we can do certain things within the business, how we're going to vote, who's going to vote on it. Is it majority of all stock? Is it majority of preferred? Is it a super majority? It's really important to understand the dynamics of what will happen in subsequent rounds as you go to run your business. Now, early stage companies, none of the investors want to run your company or be super active in your company. They're not going to be there day to day. They don't want to be looking over your shoulder or micromanaging, or at least none of the good ones do. These are provisions that should be like for major events, like raising that next round of capital, like selling the company. So how do you decide? It's also really important for the entrepreneur, because there could be a case where an entrepreneur wants to sell the company, but the right is for the preferred shareholders to vote on it, not for the common. And so you might not even have a say in that. And that might not actually even be out of market in some cases. So make sure you understand at least what you're signing up for from a protective provision standpoint. Number 5, board seats. So here's the last one we're going to talk about today. So board, what's the board makeup? Who's going to take board seats? And try and get as specific as possible. So usually your lead investor for a seed stage round is going to ask for a board seat. Same thing with a Series A. So that fund will have the right to appoint a board member. Usually in a term sheet and even in investment docs, they don't specify the name of who is going to fill that board seat. But it is the fund has the right to put somebody in place. And they can do it without asking you. So that's normal. But I would just have a conversation with your investor of like, who do you think is going to take the seat? Who's going to fill it? Because you want to know who you're going to work with. It's also a great reason as a founder to make sure you meet with all of the members of a fund. So, because what if somebody leaves? Somebody else is going to fill that board seat. You want to make sure that you have a great working relationship with your board. And one last thing on the board is how big is it? Boards don't get smaller with time. So seed stage, usually a 3-person board is pretty normal. It's usually 2 common, 1 preferred, or 1 common, 1 independent, 1 preferred at the seed stage. Then when you go to Series A, it'll usually expand to a 5-person board, which could be 2 common, 1 independent, 2 preferred at that point. And those are pretty normal mixes of boards, but it can change depending on your stage or how much you've raised and what your fundraising cycles have been like. But be aware of the board, because the board does do things like budget approvals, hiring executive approvals, executive compensation grants. It's a really important strategic element of your company. It should work for the company, not against the company. The board, in my opinion, which we've done lots of videos on, is not the thing that micromanages the startup. The board should be there for strategic support and should be there to remove barriers. All right, those are 5 key elements of a term sheet. There might be more in yours, but make sure you take a close look at those 5. If you don't, you could really miss some important things that could have a dramatic effect on the outcomes of your company.